Good morning, good afternoon, good evening. Welcome to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host, as always, is Heather Townsend. Today, we are finishing our series on real estate, and today we're talking about selling it and what to look out for, because there's a lot. If you haven't been here before, today is your lucky day. You get a freebie, and everyone who has listened before has a freebie too. You don't have to like, comment, subscribe, send it to your mom, follow the podcast, or do anything. You just get to watch it, enjoy. Next time you come back, you got to do a lot more. So enjoy this episode. If you've not been here before, we are going to talk about a lot of things. You're going to learn about us professionally, personally. We're going to dive into content, and then we are answering your questions. We start off our podcast. We talk about things in our practice. Heather's given me an inkling of her story, and I haven't heard it yet. So, Heather, how are you?
Okay, no one's heard this yet, but I am having a bad day, like a very bad day. And
bad business day, right? Can I have three guesses as to what's going on?
Yes, and I will say it's one of my biggest fears that has happened.
Okay, and it's a big problem.
Yes.
All right. You are a victim of a cyber attack.
Okay, that's way worse. No.
Okay.
Oh gosh, no. I wouldn't even be recording today.
Your largest client left.
No.
Your assistant resigned effective immediately.
No, all three of these are worse. So now
it's not a huge problem. Come on, then. Let's go.
I mean,
therapy's in session.
I am a perfectionist. So someone that I've delegated to for a year and a half that I have a lot of trust with made a mistake, made a big mistake. Now, luckily, this mistake is reversible. I'm working on reversing it, but it is one that I could say would hurt trust with a client because it was a mistake and it shouldn't have happened. When you need to grow, when you need to delegate, it's not always smooth, right? And this is my fear. This was my fear, is that now it's something that just shouldn't have happened. Mm-hmm. And it's almost adding more to my plate than taking away, right?
Sure.
So this is a sucky part of growth. I just want to be honest to listeners that it's not always roses. It's really hard. And I do have hard days. And I care a lot, which is also one of my, I'd say, is it Achilles heel? It's not Achilles heel. That's not the right term, but it's a weakness. I care sometimes too much.
You used the right metaphor there.
I did.
Congratulations.
I normally get them wrong. Okay.
Oh, if only I had the soundboard lined up, and I don't.
I'm shocked. I gave you permission to use that. Dave, how are you?
A lot better than you. I'll tell you that.
Thanks.
I'm going to try and make you laugh. That usually lifts your spirits, and make fun of you and all of that.
Yeah, I love all that.
All right, so let me pose you a question. This is what I came up against this week. I had a personal friend. Her son is friends with my son. She's like, I need some financial advice. I don't want to use you because you're a friend. And in the back of my mind, I'm like, who's going to treat you better than friends? But whatever. Can you refer me to another advisor? Sure, happy to. Mm-hmm. Found an advisor who charges by the hour, which is what she's looking for, has expertise in her problems. Left a voicemail for that advisor, said, this person's coming your way. Just look out for them, treat them well because they're coming from me. I have not met this advisor before. That advisor calls me back and then says, oh, I know who you are. My specialty is working with clients from AbbVie, which is a pharmaceutical company. She then says, oh, I have clients at AbbVie. I've used all the expertise on your website to design a financial plan for them. I didn't know how to take that.
Oh, that doesn't, okay, hold on. But my initial gut instinct is not good. Like it gives me a drop because look, we all learn from advisors. I learn from you, you learn from me. Like we all share knowledge. That's how we get better. Like multiple minds is better than one. But to solely learn from someone's website, like I really don't like that.
Yeah, so I came away from it a little conflicted. I mean, I was like, I'm glad it's out there. And like she had specific planning questions around like a deferred compensation plan that she got the answers from my website and then what it sounded like, design that into their plan. And I'm like, okay, I'm glad that that's there for you and you could help them, but I'm the expert here. Why, in a world of plenty, why wouldn't you say to that client, you know what, I think there's someone better for you. Why don't you go with this guy? Because he knows everything inside out about your work situation and then can relate it to your personal life. I understand why you wouldn't want to do that because you're losing money. But in the world of plenty, that and karma, that comes back around. So I don't know, like it's a whatever because it was yesterday. And so I'm not going to dwell on it because we're in today. But that was just something that happened. With that being said, let's dive into selling real estate.
This is such a huge part of talking through things in my financial plans, selling real estate, because it's such a sizable portion of clients' net worth.
Mm-hmm. And again, I think like in our prior real estate episodes, you're going to take the driving force behind the content and I'm going to act like I'm a client and you're going to guide me through it. And I'll ask questions as we go.
All right, selling real estate. Number one is know your cost basis. It is not just what you bought it for, regardless if it's a primary or a rental property or a second home. It is not just what you bought it for. Because your commissions also that you have to pay real estate commissions, those add to your basis. Improvements add to your basis, especially in a primary or secondary home. And Dave, I don't know about you, but I don't know a client who has owned real estate unless it's for a very short period of time and they haven't spent improvements on their home.
We've all seen those Zillow houses that haven't been updated in 40 years, but they're 1 in 100. Most houses have got updates.
But even if 40 years, I don't think an air conditioning lasts 40 years or a water heater or
Sure.
Those are improvements, right? So those add to your cost basis. Now, if you have a rental property, you're expensing those or depreciating those. So different situation. If I just put down what my realtor thinks we could sell the house for after this remodel, if I just put my cost basis for what we bought it for, I would be out of the capital gain exclusion.
So I think that's the important part with primary, right? Primary residences. A lot of people are still going to be in that capital gains exclusion of that 250,000 single, 500,000 married. So it doesn't necessarily matter. But as soon as you get out of that, then this is where the basis becomes really important of tracking it, keeping receipts and whatnot.
Exactly. All right. Now on a rental, I've seen this many times with my clients is they go, oh, well, after paying real estate commissions and what I put into it, I really didn't have a gain. And I'm like, wait. Maybe in your head, you don't have a gain. But if you've depreciated for multiple years, you've been reducing your cost basis all along. Your tax cost basis is way different than what your cost basis is in your head. You're reducing it because you're writing off a portion of those improvements or the building you bought every year. And so if you've listened to my previous, episodes, you need to know that tax cost basis and how much depreciation you have taken, because that is gonna come back around when you go and sell it. Second home, same thing. You don't get the capital gain exclusion because it's not your primary residence, but you probably haven't depreciated it. So that's then where your improvements still count, and you're going to pay long-term capital gain rates, assuming you've had it for more than a year on any gain. If you have had a long-term rental, so non-Airbnb, you're not a real estate professional, so you haven't been able to write off all your losses, that's also going to come into play, right? Those suspended losses on your rental property, if you're selling a rental property, will come back into the gain. The interesting thing on our tax loss harvesting with selling equities, stocks, making paper losses in Schwab, let's say, or Fidelity, right? You can't use those with passive income, right? We've talked about this, right? Real estate income, right? You can't use it to offset. But when you sell real estate, now you can use your capital losses to offset your capital gains of real estate.
So if you had some losers of stocks and you sold them and you're just sitting on a loss, you can use it against a gain of a house.
Mm-hmm.
All right. What if I don't want to sell my house and realize the taxes? What can I do?
Well, 1031. So 1031 is you are taking an investment property. It cannot be a primary residence. You are taking an investment property and swapping it for another investment property. And if you don't do this right, and most people who are doing this are sitting on a sizable gain that they do not want, taxable gain that they do not want to recognize this year. And this is how you get out of it. 1031. Let me first say, you must use an intermediary. Such an odd word. Intermediary. Yes. And
You got it right. Way to go.
I know. I'm glad you're here to check me. Any real estate realtor should have one in their Rolodex. That's such an old term, because you cannot take possession of the funds. If I sold it and I deposited those funds in my own bank account, big no-no. The intermediary has to hold the funds in an escrow account. So if you are going to 1031, you need to know that from the beginning, and you need to have that intermediary lined up.
Okay. What if I didn't want a house anymore? Can I sell a house and buy a commercial building?
I believe so. For that, I'm not a 1031 expert. I go to the intermediary. So I believe so. I could research that, but I'm not going to give an answer that I'm not fully positive of. I'd have to research that. But my answer is I think so. Check with your intermediary.
Yeah, I didn't realize the rules had changed that much, because I thought it had to be like kind real estate. So like investment house for investment house. I didn't realize you could do different properties now.
I do know that clients have taken their long-term like rental property and put it into one of those private real estate funds.
Mm-hmm.
Like they wanted completely passive. They didn't want to be the manager anymore. So I have seen that.
Okay.
So, and then so it can't be used for primary. The other interesting thing is you have 45 days to identify a replacement property, and you have 180 days to close on the new property. Let's say you're going to sell a investment property and you want to 1031 it. It doesn't mean right away you have to know which investment property you're going to go swap it for, right? But you do need to close on it within 180 days. So that timeline scares me. I think because I mean, what if the market just shifts on you? There's so much that could happen, right? In this world, I think I'd already want to have my property identified before to ensure that I was going to 1031. Like I knew exactly which one I was going to 1031 it in.
It seems odd that you would be selling something without having anything lined up, because it's very easy just to disqualify that whole 1031, and then you're stuck on a taxable gain.
If you can't find anything, that's the scary part. Yeah. So I think if you already know what you're exchanging it for, it can be a great tool. If not, that scares me a little bit.
Sure.
The capital gain exclusion, going back to primary, we didn't talk about this. You have to have lived in it in the last 2 of the 5 years. I think we've talked about that on previous podcast episodes. So I have had clients that have upgraded their house, but they decided they didn't want to sell their primary right now. It just wasn't the right time in the market. So they rented it for a few years and then they sold it. You can still get the capital gain exclusion. You're going to have to pay any depreciation recapture back, but.
All right. I just did an exam on this yesterday. What if that's flipped? What if and I'm going to test to see if you know the answer.
Okay,
what if you have an investment property and you rent it for 3 years, then you sell whichever house you're living in and you move into that investment property and you live in it for another 3 years, essentially becomes your primary 2 of the last 5 years, and you sell it. Do you get the capital gains exclusion?
My answer is yes, because you just can't take it within 2 years of each other, the capital gain exclusion. Am I correct?
You would be wrong.
Why?
Because it was initially classed as an investment property. So it's a
Wait, I thought you said they lived in the primary home. They lived in one as their primary home.
Yeah, then they sold it, and then they moved into their investment property and lived in that for the next 3 years.
They never lived in their investment property as their primary.
They bought it as an investment property, rented it for 3 years. Then they moved into that property, lived in it for another 3 years, and then sold it.
That's interesting to me because you created it as a primary.
It's the order of what you do it. If you rent it first, it's a pro rata exclusion.
Interesting.
And the only reason I know that is because I got tested on it yesterday. Will I forget it in a week? more than likely, because I've never used this.
That's why I always research. I mean, that's interesting. I just learned something new. So it's the order, because you're right. I've never had a client take an investment property and then move into it. Okay, I heard an interesting thing too the other day. Now that the estate exemption is permanent, I'm putting it in quotes, I think it's permanent, right, to 15 million, kids gifting real estate or high appreciated assets to their aging parents to just push it back down to them. Whoa, that's really smart. If you have a family unit, that's really trustworthy. Let's say I bought this pre-COVID. Gosh, I wish I did, right? And I think I'd be sitting on a $1.5 million gain. Yeah, it hurts. And I was like, I don't really want to recognize this. So I'm going to gift this property to my mom, right? Like, I'm just going to gift it to her, or my grandma, right? Like, I mean, that's a lot of trust, because, you're gifting them like $3 million of real estate, but then they pass away, and then like,
as long as they give it back to you in the will.
That's why they said fine. Trust. I think it's a little risky. I wouldn't want to do it, but I was like, there is so many interesting planning. I mean, I'd get an estate lawyer involved and all of that, but it was a very interesting thought.
This is our question portion of the podcast. It's called What Would You Do? The sad thing is we have discussed a lot of these things almost in detail, but we'll cover these things in questions so we can make sure you understand things. So question number 1. I have lived in my primary house for 3 years, and then I rented it for 3 years. Do I still get the homeowner's gain exclusion when selling my home after that period?
It's the order that I've just apparently learned of this exception. So they lived in their primary first. So yes, they do.
So the short answer is yes. The long answer is be careful, because if you depreciated it while you rented it, you'll have to pay some of that taxes.
Yeah. Hopefully it's not too much, though, if it's just for a few years. Okay, I have been buying and selling real estate for 20 years, using 1031 exchanges to avoid taxes on the gains. I'm now 75. My current rental has a gain of 2.5 million. If I die before selling it, do my heirs get a step up in basis and avoid paying taxes on the gain?
Yes. Question done. Let's let you how it works. You want to give highly appreciated assets. You do not want to sell them. You want to have your heirs inherit them, because then they essentially inherit them as though they bought them on the day that you died.
That's where I was thinking through this. I was like, why would you sell it? Because you're going to have to then pay the taxes on it, which will then reduce the estate. Just hold it. Let them sell it with the increase in basis. This is where I was talking about with the 1031 with inheritance.
I think the confusing part people have is, well, if it's in that 1031 sequence, like, does someone have to pay the taxes essentially at some point? Well, if you die, no one will pay the taxes. They'll just inherit it, and the taxes essentially disappear.
Is that what you just learned in your tax class?
One of the many things that I got tested on.
Because I was like, ooh, I want to double check that, because I haven't had to research that. I haven't had a 1031 inheritance issue yet.
All right, question 3. I own 3 rental properties, and I need to decide which one to sell. I have significantly depreciated 2 of them, but I haven't done so with the third one yet. Each property will yield $100,000 in cash when it's sold, which is what I need. How can I determine the best property to sell?
I mean, I'm going to guess the third one, if they haven't depreciated it very much yet, the market hopefully hasn't moved too much on them. So they're probably going to have the least amount of gain, right? Because they won't have depreciation recapture and they wouldn't have owned it as long. So from a tax perspective, it's probably best to sell the third one. But now going to the bigger, financial plan of these clients and, details of them, you'd want to start asking questions. Well, which one performs the best? Which one's in a market that has the highest appreciation? Are you too diversified, right? Like, what if the third is in a totally different area and the other 2 are like, there's many things I'm thinking through of this that I'd want details. What if the third one rents really, really well and the other 2 don't, and they're the trouble childs, right? You don't, there's always a trouble child, I feel like, with my clients' rental properties. Some of them are
Sure.
smooth, and then there's a literally, we sometimes call them trouble childs.
All right, let's go into highlights. This is the part where you get to know about us personally, whether you want to or not.
Right now, right now, I think this is a positive. We'll see. But Alex and I are about to go 16 days without childcare and no childcare. Well,
what?
Yeah. And we are on day 5. I'm not counting.
Where's the nanny?
The nanny is in Orlando for her daughter's soccer tournament. And next week we are going to Jackson Hole, which I can't wait to see Jackson Hole. I think it's a smart that I check out that area before I really commit to buying in Park City. It's only 4-hour drive. And Alex and I were like, well, why don't we go? And I'm actually really enjoying, because it feels like a summer a little bit, of I'm spending a lot of quality time with my girls. So Alex and I are kind of tag teaming, being with the girls and working as a team. And I'm scared to say this, but it's a lot easier than I thought it was going to be. But we are only on day 5 of 16.
Just wait until something happens. And you're like, this is what the nanny, oh, she's not here. Okay.
Yeah.
Well, I'm glad it's going well. And you're starting to enjoy the family time together. And especially with the summer, because we're not going to say the date, because sometimes we pre-record well ahead of time. But summer is past its halfway point, I would imagine.
Yes. And we don't get this time back. I'm always reminded of that. So,
speaking of stuff like that, yeah, my highlight, sports are over in our house for a week. That's as much break as we get. Baseball's done. Had the party. My high schooler is actually at football camp right now. So he's in sports, but I don't have to do anything for it. But football starts next week.
Well, I hear that's actually a big deal, because everyone tells me that I need to get prepared for the activity stage. That's when you're driving around like you're a taxi cab driver. So I'm sure you really like not being in the activity state with like the very drilled schedule.
It's different, because now you're having to, I mean, you now have time to do stuff together as a family, but now you also have to entertain teenagers.
I know.
Who sometimes can entertain themselves, sometimes they can't.
Or they watch TV all day, right? And you're like, I don't want
TV, sleep, video games, or on the phone. Pretty much, that's it.
On the phone? Wait, on the phone, like talking on the phone, or on the phone scrolling, texting?
Both.
They talk on the phone?
My youngest has a group chat. They're on the phone all the time. Yeah, there could be like 12 of them in there.
Talking?
And they're just, chatting, hanging out, making fun of each other.
Oh, I love that. I really don't want, I'm really worried that the future generation is just going to be all screens, like texting, and forget how to communicate live.
I think that's already here, because I can look at my other son and I'm like, when did you talk to someone on the phone? He's like, what? Boomer? Shut up. I'm a millennial, sir. Thank you. Anyway, Jordan, you're up.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
And that's Jordan. He's amazing. Thank you, Jordan. Thank you, listener, for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts. And if you want to watch the video version, it's on YouTube, LinkedIn, and Instagram. If you want to send us an email, you can get your opinion on the show. Just tell us how much you like it. Tell us how much the audio quality has gotten better over the last few months. I don't know, whatever you want to tell us. You can contact us at hello@playbookotw.com. And we'll see you next time.
Toodles.